Even if you're just getting started with learning to trade, I'd say the chances are you've probably already come across the term PIP. It's quite a common term in trading, particularly for Forex trading and cryptos. But what exactly is a PIP? That's what I'll be explaining to you in this video. And as always, if you want to learn how I've traded for the past 2 decades, check out the description box down below for more details. So a PIP is a price measurement that's usually used when trading currencies, so Forex trading. But you will occasionally hear people use the term for other markets as well, although usually the term points is more suitable for other markets. Now, a PIP is traditionally the smallest price movement that can happen within a currency pair. For the majority of pairs, 1 PIP will be equal to the 4th decimal place. So for example, if we look at Euro USD, US dollar, and assume that the price is currently 1.0745, now if the price moves up to 1.0746, that is a 1 PIP move. Easy, right? Now, for some currency pairs, this will be a little bit different, particularly for pairs where a currency other than the US dollar is the quote currency, meaning the second currency in the pair. So we have the base currency and the quote currency. For example, pairs involving the Japanese yen. In those cases, when the yen is the quote currency, a PIP is the 2nd decimal place. So if the price of dollar yen moves from 133.88 to 133.89, that would also be a 1 PIP move. Now, I did say that a PIP was traditionally the smallest movement in a currency pair, but you may find that some brokers these days add another decimal place to the end. This is known as a fractional PIP, or sometimes a point. It's good to know about these, but it's not really going to make a huge difference because most of the time the pips are all you're going to need for calculating most things with your trading. So what are the practical uses of pips then? Well, measuring how far the price has moved or could move is going to be really important for many aspects of your trading. For example, for your risk management, you'll need to know how much money you could potentially lose on your trade. So to do that, you can figure out how many pips you'd allow the price to move against you before you exited the trade. For example, how many pips between your entry price and your stop loss. And if you know how much a pip is worth to you, which you'll know based on your position size, you'll know the total amount of money you could potentially lose if the price reaches that point where you exit a trade in a loss. And if you don't know about position sizes yet, click up here to watch a video about that. Likewise, a similar calculation is going to allow you to figure out your potential profit. If you know your position size, then you'll know how much 1 PIP is worth to you. So if you calculate how many pips the price could move in your favor, you'll be able to calculate the profit for the trade. You simply multiply the amount for 1 PIP by the number of pips of that price move. And so with this information, you can also easily use these pips to measure your risk-reward ratio. This ratio shows you the difference between how much you have at risk compared to how much you could potentially profit. And by measuring the distance in pips, you could create a simple ratio. So for example, if your stop loss is 20 pips away and your profit target is 100 pips away, you know you're risking 20 pips to potentially earn 100 pips. That's a 1:5 risk-reward ratio. For every 1 that you have at risk, you could potentially earn 5. Now, measuring pips is usually quite straightforward with most trading platforms, so don't worry if maths isn't your strong point or anything like that. There's typically going to be a crosshair or something like that, which you can drag across the price move that you're wanting to measure, and then it will show you how many pips that price move was. So in this case, we're using MT5, that's MetaTrader 5, and you can see it's 15 pips for that price move. And here, if we look at TradingView instead, again, you can see a 15 pip price move. So understanding pips may seem a bit basic, but it's really important to understand, particularly for risk management, which is one of the most important parts of your trading to get right if you want to succeed long term. Now, as I mentioned earlier, if you are learning to trade, make sure you check out the links in the description box to find out more about how I trade. And if you found this video helpful, I'd really appreciate it if you let me know by hitting the thumbs up button. Thanks for watching.